Welcome to the Deep Dive. Today, we're really digging into the Q1 FY26 financials for L&T Technology Services, LTTS.
Right.
You sent over this, mountain of info transcripts, press releases, financial statements.
Yeah, quite a bit there.
And our job is to kind of hack through all that data, find the real gems, what truly matters, what's genuinely surprising, and what it all means for the bigger picture in engineering services.
Exactly. And those sources, they're incredibly rich. LTTS, for anyone maybe not tracking them super closely, they're a global leader in ER&D services, engineering, research, and development.
Yeah.
A listed subsidiary of Larsen & Toubro, big name. They've really focused their efforts across three main areas: mobility, sustainability, and tech.
Got it.
And their customer base is impressive. We're talking 69 Fortune 500 companies, 57 of the top ER&D firms globally. So yeah, they're definitely playing at the top.
Okay, so given all that context, what were the headline numbers this past quarter? What jumped out at you right away?
Well, okay, for Q1 FY26, that's the quarter ending June 30th, 2025, revenue in USD terms, it landed at $335.3 million.
Okay.
Now, that's strong growth year on year, 13.6%.
Right.
However, if you look quarter on quarter sequentially, USD revenue actually dipped a bit, down 2.9%.
Oh, interesting. Why was that?
It seems to stem largely from the seasonality of their Smart World and Communication SWC part of the business,
Okay.
plus some noticeable headwinds they're facing in the mobility sector, which we can get into.
Right.
But despite that sequential dip, net profit still managed to tick up. Came in at 316 crore. That's up 0.7% year on year and 1.5% quarter on quarter.
So profit held up better than revenue sequentially.
It did. And here's maybe a testament to their operational side. The EBIT margin held steady at 13.3% for the quarter, which, given those revenue impacts and market challenges, shows some real resilience there.
Okay. That sequential dip in revenue, even with the year-on-year growth, that immediately makes me wonder about their overall strategy. Are they just reacting to market conditions, or is there a bigger play here?
Yeah, management's quite clear on this. They emphasize their multi-segment diversification strategy. They think it's proven resilient, particularly now when things are so dynamic.
Makes sense.
They talk about a go deeper to scale approach. And that, combined with proactive investments in new tech, that's apparently leading to stronger client partnerships and, importantly, robust TCV bookings. Total contract value.
Right, TCV.
So it feels less like just riding out the storm and maybe more about using that diversified base to invest and build for future growth, even when some bits are under pressure.
And speaking of strength, that robust TCV booking, large deals, are they consistently pulling those in? That's always a key indicator.
They absolutely are. They've kept up what they call their large deal momentum. For the third quarter in a row, they surpassed $200 million in large deal TCV.
Third quarter, wow.
Yeah, pretty consistent. This quarter included one really significant deal, over $50 million, then 3 deals in the $20–30 million range, and another 6 deals over $10 million.
Okay.
And they actually clarified something going forward. LDTCV, large deal TCV, will specifically mean deals over $10 million each from now on. Just streamlines the reporting, I guess.
Got it. But that consistency is impressive, especially when you hear so much about market caution.
It really is.
So what's the leadership's outlook then for the rest of FY26 and beyond? Are they as optimistic as these big deals suggest?
They're certainly projecting confidence. LTTS expects to achieve, and this is their quote, double-digit growth over FY25 for the full year FY26.
Okay, double digit.
And they're sticking to their medium-term outlook of $2 billion of revenue.
Ambitious.
It is. Their confidence seems rooted in a robust backlog order book, which they say has been growing quarter on quarter and year on year. Plus, they mentioned a healthy pipeline of $50 million plus deals.
So the pipeline supports the outlook.
Apparently so. And on the margin front, they expect EBIT margins to improve in the coming quarters. They even have an aspiration to reach mid-16% level sometime between Q4 FY27 and Q1 FY28.
Mid-16s.
Okay.
So yeah, while Q1 had some, bumps, they're painting a clear picture of strong future performance.
That's a really comprehensive overview. Now, this is where it gets really interesting for me. Let's pull back the curtain a bit. How did each of their core segments actually do? Let's start with sustainability. I hear that was a real bright spot.
It truly was. Sustainability is highlighted as LTTS's most profitable segment, and yet it performed exceptionally well this quarter.
Oh, well.
Grew 16.4% year-on-year and a solid 4.1% quarter-on-quarter. Crucially, it crossed the $100 million quarterly milestone for the very first time.
Wow, $100 million in a quarter.
Yeah. On a run rate basis, that makes it a $400 million plus annual business now.
Okay.
And what's really striking is, with this, all three of their main segments, mobility, sustainability, and tech, are now each at or above that $400 million annualized revenue mark. So they're all substantial pillars now.
Exactly. And more than half of the large deals they won in Q1 were actually in sustainability.
Makes sense, given the growth. What's driving it?
Seems to be strong demand in plant engineering. Think oil and gas, consumer packaged goods, new facility builds, upgrades to existing ones, modernization, efficiency, safety stuff for older plants.
Right, broad industrial needs.
Yeah. And they're also seeing ramp-ups in industrial projects, specifically because of AI and machine learning interventions in their product development lifecycle offerings, PDLC.
Okay, so AI is creeping in there too.
Definitely.
That's phenomenal growth. Any specific wins in sustainability that really showcase what they're doing? You mentioned the big $50 plus deal earlier. Was that this second?
Oh, yes, good catch. That $50 million plus agreement was indeed in sustainability. It's with a global energy major for enterprise data and digital services.
Okay.
And what's really notable about it is that it's based entirely on LTTS's own proprietary tools, not just standard solutions.
Interesting. Shows their IP value.
Exactly. They also signed a strategic deal with Tennant Company, the cleaning solutions people, to advance sustainable new product development. That includes setting up a dedicated offshore engineering center for them.
Right.
And another one, a definitive agreement to support product sustenance and lifetime development for a semiconductor equipment maker across multiple product lines.
So diverse wins within sustainability.
Very diverse. And to underscore that profitability point you made earlier, this segment's margins for Q1, they came in at 27.4%.
27.4, that's huge.
Yeah, a significant improvement, as they put it. It's definitely their powerhouse right now.
Okay, from that high-flying segment, let's shift gears to mobility. We heard some cautionary notes there. How nuanced is that picture, really?
It's definitely more nuanced, yeah. While some subsegments did well, like trucks and off-highway and aerospace and rail grew okay sequentially and year-on-year,
Okay.
the really critical auto segment, well, it continues to be in flux. That's their term.
In flux, what does that mean practically?
They point to a couple of key challenges. One is China's alternative low-cost innovation and stack in areas like EVs, which is disrupting the established global players.
Right, the competitive pressure.
Exactly. And then there's the continued consumer demand for more software-defined vehicle features, SDV. But that's running up against really high ER&D costs for the OEMs, particularly in the US and Europe.
So they want the features, but they're expensive to develop.
Precisely. So what LTTS has seen is, quote, a short-term pause on some programs and delayed starts in others.
Right, delayed decision.
Yeah. LTTS anticipates automotive will likely remain, their word is muted, in the short term, maybe for another couple of quarters.
Right.
They do see growth returning after that, though. And overall mobility should see a turnaround in the second half of FY26. That's the expectation.
That's a pretty stark picture for mobility near term, that muted outlook. But you mentioned LTTS is investing in solutions like iDrive 2.0. Is that response enough? I mean, how are they differentiating if everyone's facing similar pressures?
That's the critical question, isn't it? Their strategy is to invest heavily in these solutions. LTTS iDrive version 2.0 is launching very soon, they say, in the next 2 months.
Okay.
And crucially, they claim to have production customers already for version 1.0 and customers lined up for 2.0. So it's not just vaporware.
Right, actual adoption.
Full flow.
Right.
They're also building out specific stacks for EV and hybrid vehicles. And they're coupling this with their offshore delivery model, trying to offer a lower cost base to clients feeling that R&D pinch.
Makes sense. Did they land any deals despite the headwinds?
They did. They secured a multi-year deal with a U.S. automotive components maker. This involves engineering support, including ANSPICE compliant systems.
ASPICE. That's a big quality standard, right? For software safety.
Exactly. Very important in auto. So covering systems, software function safety, cybersecurity, quality assurance. They were also named the strategic supplier for ThyssenKrupp steering. And slightly different, Triton Group, a satellite company, awarded LTTS a significant deal for software design, development, and embedded engineering for airborne systems.
So still winning across mobility, even outside pure auto.
Yeah, overall, Mobility still managed to win 5 deals over $10 million in Q1. So the demand, or at least the pipeline, seems to be there.
But the margins?
Ah, yeah. Despite those wins, the segment margins for Mobility came in lower this quarter at 15.3%.
Mm.
They attribute that to, well, those delayed decisions on large deals we talked about,
Hmm.
pauses in existing programs, and also customers apparently seeking discounts.
Right, cost pressure hitting them too.
Exactly.
Yep.
So the solutions might be good, the wins are happening, but the market dynamic is definitely challenging for them right now.
Okay. And finally, the tech segment, what's driving things there? And what about the dynamics now that IntelliSwift is integrated?
Right, the tech segment. So year on year, it grew a strong 29.4%.
29%.
Yeah, but that primarily reflects the benefit of having IntelliSwift's revenue included for the full quarter this time around.
Ah, okay. The acquisition effect. What about quarter on quarter?
Quarter on quarter, it was actually down 8.5%.
Down.
Mostly attributed to that seasonality in the smart world and communication. The SWC subsegment that we mentioned affected the overall top line.
Got it. So SWC seasonality hit both overall revenue and the tech segment QOQ.
Seems so. Within tech, they highlight the software and platform subsegment. It's software, and interestingly, agentic AI offerings are apparently seeing a good response from customers, hyperscalers, fintech, healthcare.
Agentic AI, okay.
They also mentioned progress in medtech. They've onboarded new logos there, especially in the ophthalmology space, and expect that to grow more in the second half of the year.
Any interesting innovations or specific ventures in this tech segment that stood out to you?
Definitely. In the smart world area, they've developed something they call a domain-centric computer vision ops platform. Sounds techy, but apparently it's applicable for urban and smart spaces, public safety, utilities, manufacturing, real-world uses.
Practical applications?
Exactly. And they recently won a safe city project in India. This uses AI and analytics to enhance public safety, including an adaptive travel and traffic control system.
A safe city project. Interesting. That feels like a growing area.
It does. It shows they're not just doing traditional IT, but applying tech in these, civic and infrastructure ways.
Mm-hmm.
Oh, and another point, their expansion into the Middle East is progressing. They're setting up a strong foundation with a pipeline and expect FY26 will be the year they actually start booking revenues from that region.
Okay, new geography coming online. What about margins in tech?
Tech segment margins for Q1 came in at 9%.
9%. That seems quite low compared to sustainability's 27%.
It is lower, yeah. A decline from the previous quarter, too. They attributed this to continued strategic support for select programs and customers. Might mean investments or discounts to secure key clients. But they did say the integration plan for IntelliSwift is fully on track and is showing improvement in revenue growth and margins as they bring that business fully into the LTTS fold. So maybe some uplift expected there over time.
Right. Beyond just the segment numbers, it's like crystal clear that innovation is a core focus right across LTTS. Tell us a bit more about their tech breakthroughs, what's happening with patents.
Yeah, innovation is huge for them, you're right. AI, in particular, they state it's becoming central in our deal wins and it's establishing strategic partnership with our clients.
Not just a buzzword, then.
Seems not. They explicitly say the AI wave of engineering ER&D is beginning to gain traction, and their engineers. They have apparently deployed multiple AI programs for clients already and filed an impressive 206 patents just in the AI domain.
206 AI patents. Wow.
Yeah. And a really significant development they announced is the launch of Plex AI.
Plex AI, what's that?
It's their own proprietary AI framework. They say it accelerates product development lifecycle for global customers. It combines things like smart prompting, contextual intelligence, and agentic workflows.
Okay. Where did it come from?
And what's really insightful here is that Plex AI was actually incubated within the mobility segment originally.
Ah, interesting. Came out in the challenge segment.
Exactly. But now it's been scaled and propagated to other segments using a multi-vertical cross-pollination innovation approach. That shows some real internal leverage of their R&D, not just keeping innovations siloed.
That is smart. Cross-pollination. What about the overall patent portfolio?
Overall, it stood at 1,550 patents at the end of Q1.
1,500.
Yeah. And interestingly, 952 of those are co-authored with clients. The rest were files solely by LTTS, often to address specific areas where clients are investing heavily, especially in the U.S. market.
That's a lot of innovation, and it sounds like they're really making an effort to, institutionalize it, put down roots for it too, right? Not just have it floating around.
Precisely. They just inaugurated a brand new design center down in Plano, Texas.
Texas, okay. Focused on what?
Specifically focused on cutting-edge tech, cybersecurity, and AI. And importantly, it's an ITAR-compliant facility.
ITAR. What does that mean?
It means it meets strict U.S. government regulations for handling defense-related technology and data.
Ah, okay. That's significant.
It really is. It's a big competitive differentiator, opens doors for certain types of projects. This investment really underscores their commitment to delivering advanced solutions, but also establishing more nearshore centers, being closer to clients, especially for sensitive work.
Right. A strategic move, being near shore and having that ITAR compliance.
Definitely. Closer to U.S. clients and talent.
Okay, let's shift just a bit to the operational side. How are they managing, their people, their cash flow, overall efficiency in this kind of dynamic environment?
Right, the nuts and bolts. So headcount stood at 23,626 at the end of Q1. That's actually a slight decrease from the previous quarter's 24,258.
Headcount down slightly. Attrition.
Attrition came in at 14.8%. Not drastically high, not super low either for the sector.
Okay. What about cash? DSO.
Yeah, cash flow. Their Q1 day sales outstanding, DSO, basically how quickly they collect payments, was 98 days.
98 days. How does that compare?
It's up from 88 days in Q4. And their combined DSO, which includes unbilled revenue, was 116 days, up from 106 in Q4.
So taking a bit longer to get paid, is that worrying?
Well, it's an increase, definitely something to watch.
Yeah.
But they did say it's still within their target range for the year, which is 110, 115 days for the combined figure. So not a red flag just yet, but you'd want to see it stabilize.
Right. And free cash flow.
Free cash flow is actually negative 28 crores for the quarter.
Negative. Why?
They attributed that mostly to the seasonality of the Smart World business when we talked about likely timing of payments on large projects.
Okay. Seasonality again. And overall cash position.
Cash and investments stood at 2,431 crores. That's down from 2,981 crores at the end of Q4.
Why the drop?
Mainly due to paying out dividends and the balance payment for the IntelliSwift acquisition hitting the books in Q1.
Got it. Acquisition costs and dividends. What about efficiency metrics like offshore mix?
Yeah, their on-site offshore mix showed a slight improvement towards offshore. It now stands at 56.1% offshore.
Which is generally more cost-effective.
Typically, yes. And their time and material, or T&M, revenue mix was 62.2%. That indicates a good chunk of their work is based on effort spent rather than fixed price, which can offer more flexibility in dynamic projects.
Okay. And what about their client relationships? You mentioned the Fortune 500 numbers earlier. Are they deepening those key accounts, or are clients becoming more cautious with spending across the board?
They're definitely seeing some deepening, it seems. The number of million-dollar-plus accounts actually showed sequential improvement in the $1 million, $5 million, and $10 million categories.
Oh, really? Improvement there.
Yeah. They now have 200 clients in that $1 plus category. That's up from a 194 in Q4, and that Q4 number already included the IntelliSwift clients.
So organic growth in larger accounts.
Seems like it. And total active clients also increased, up to 459 from 421.
Okay. Any softness anywhere?
Well, they did mention that the contribution from their top 20 clients was slightly muted compared to Q4.
Ah, okay. The biggest clients were a bit slower.
Slightly. But the company says they're running targeted programs on client mining, basically trying to grow those existing big relationships, and they expect improvement there.
Client mining, okay.
And a significant milestone they expect to hit in Q2 is reaching their first $50 million annualized run rate account yet again.
Yet again. So they've had one before.
Sounds like it. But hitting that level consistently speaks volumes about their ability to grow relationships into really substantial partnerships.
Definitely a key metric. So given all the segment performance, the deals, the operations, what's the executive team telling us about the broader market sentiment and their confidence moving forward? Are clients genuinely, loosening their purse strings, or is it still very much a wait-and-see game?
Yeah, the management acknowledges the market is still dynamic. They said clients are still a little cautious on decision-making. No surprise there.
Right.
However, based on multiple conversations they've had and something they described as a confidential poll across their client base.
A confidential poll. Interesting.
Yeah. They say a large number of our clients see things stabilizing and that H2 potentially being better than H1. So cautious optimism maybe.
Okay, stabilizing. H2 better than H1. What about spending drivers? AI.
Absolutely.
Yeah.
AI remains a central area of focus. They explicitly state, again, that the AI wave of engineering ER&D is beginning to gain traction.
Okay.
And that same poll apparently indicated that 30% of the clients are engaged in full-fledged AI programs already. Others are still in the proof of concept stage, but it suggests, as they put it, the AI spend appears to be real, not just talk.
So AI is a tangible driver. Anything else?
Yeah, other future spend drivers they highlighted include setting up more localized and regional supply chains.
Makes sense.
The ongoing trend of software-defined everything, not just vehicles, industrial automation in the near term.
And even robotics and humanoids in the medium term.
Robotics and humanoids, interesting. Looking further out?
Yeah, medium term.
Okay, this raises a really important question for me. If clients are still, a bit cautious, and we saw that sequential revenue dip in Q1, how are they so confident in hitting those double-digit growth targets, and especially those improved margin targets they mentioned? What are the actual levers they plan to pull?
That's a great point. They did outline pretty clear levers for that margin improvement trajectory. It's not just hoping the market gets better.
Okay, what are they?
First, revenue mix. They expect that continued momentum on large deal wins, especially in the higher margin segments like sustainability.
Right, the 27% margin segment.
Exactly. Winning more there will naturally improve the overall average margin. Second, productivity. Just getting more efficient internally.
Things like optimizing their pyramid structure, the mix of junior and senior staff, increasing fresher intake, which lowers average cost, driving more offshoring, which we saw a slight tick up in, and leveraging automation and AI internally for their own processes.
Okay, operational efficiency. Makes sense.
Third, SG&A costs, sales, general, and admin. They expect these to model somewhere between 10.5% and 11.5% of costs going forward. They're focusing on optimizing and managing these efficiently, especially now that IntelliSwift is being integrated.
Right, controlling overheads.
And speaking of IntelliSwift integration, that itself is a key lever. It's a core part of their plan, and they expect it to incrementally improve margins over the next 8 quarters.
8 quarters, so a 2-year plan for full synergy realization.
Seems like it. They've combined IntelliSwift's hyperscaler business with their own already, and they're strategizing now to grow other subsegments that came with IntelliSwift, like retail, fintech, non-banking, private equity, even pet care, aiming to make each of those $100 million businesses within 6 years.
Wow, ambitious targets for the acquired segments too.
Very. And finally, they explicitly confirmed that H2 should see better margins than H1, partly because some of those strategic support programs, the ones that likely involve discounts or investments, and hit Q1 margins, maybe Q2 as well.
Right. The ones dragging down tech margins.
Exactly. Those are expected to either phase out or hopefully convert to regular billing by Q3.
Okay, so phasing out strategic investments should help.
That's the plan. So yeah, it's a multi-pronged approach. Better revenue mix, internal efficiencies, cost control, acquisition synergies, and phasing out some support costs.
That does sound like a concrete plan. Okay, one last area to circle back on the automotive segment. Why does LTTS sound maybe more cautious than some of their peers we hear from, even with their new solutions like iDrive? What's the real sticking point for them there?
Yeah, they are maintaining that more cautious stance on auto. They cite a few reasons pretty clearly. One is the ongoing flux, that word again, in the U.S. automakers. There's uncertainty over continued heavy investment purely in EV versus potentially hedging bets and returning some focus to internal combustion engines.
Kind of a strategic pause or pivot?
Maybe, or just uncertainty. Then there's the pressure on European OEMs, specifically from China's low-cost EV stack, forcing them to basically reimagine the stack for their own vehicles to compete.
Huge challenge for the incumbent.
Massive.
Yeah.
And finally, just the broader market dynamics causing a delayed rollout of some of those advanced software-defined vehicle features we talked about earlier. It's just a really complex, shifting landscape right now.
Yeah, sounds incredibly disruptive.
It is. But despite this caution, LTTS does believe their built-up stack things like iDrive 2.0, and remember Plex AI actually came out of mobility.
Right.
They believe those investments position them well for when things pick up, and they are still winning deals, as we saw, and they say they have a robust pipeline. So they fully anticipate that recovery in H2 FY26. It really seems more a matter of timing and navigating this truly disruptive period carefully.
Okay. It really sounds like a challenging, yes, but ultimately promising period for them, with a very clear, quite deliberate strategy guiding them through. So just to kind of distill all this down, LTTS is navigating what's clearly a dynamic market, but they've got this robust, large deal pipeline, right? They're making strategic bets on AI with things like Plex, new design centers like the one in Texas, and relying heavily on that diversified segment approach. Sustainability is, well, unequivocally the shining star right now.
Absolutely.
Mobility faces some definite near-term headwinds, but the future outlook seems strong as the market hopefully stabilizes.
That's the bet.
And the company seems really committed to hitting those double-digit growth and margin expansion targets, backing it up with operational efficiencies and strategic integrations, especially in Teleswift.
Absolutely. I think the company's focus is unmistakably on resilience, yes, but also profitable growth. They're showing a pretty disciplined approach to managing costs, and they're clearly keen on leveraging their IP, their patents, and deepening those client relationships to meet what are clearly evolving market demands, especially around AI, which just keeps coming up.
Yeah, AI is everywhere. So thinking about all this, what does it mean for you, the listener, as you consider the future of engineering services? With companies like LTTS making these significant investments in proprietary AI frameworks like Plex AI and expanding their footprint into areas like safe city projects, even defense-related product development, how might this blend of sort of cutting-edge tech and really practical real-world applications, how might that fundamentally change the way we all interact with our urban environments, our products, their life cycles in the years to come?
Yeah, and it's also worth considering the broader implications of that increasing focus on nearshore delivery, like the Texas Center, combined with those proprietary AI frameworks. How might that reshape global technology development, maybe reshape access to innovation, creating new hubs much closer to the actual clients? Something to think about.
That's a really provocative thought to mull over, the geography of innovation shifting. Thank you for joining us on this deep dive. We look forward to our next one.